welcome again. This is our second breakout session. My name is Cayenne, like the pepper. I'm here on behalf of RBC Commercial Bank. And just so you guys know, like I said in the first session, I know this mic does not work. I've not had many beers. This is really for the camera, okay? So today I'm here with my RBC team. I've brought along 5 experts for you guys. We are here today with Mike Sally. I have my leasing expert, Carolyn, my trade finance expert, Lyna here, and then last but not least, Jonathan, who will speak to us about your employee wellness for your, financial wellness for your employees. So I'll pass it off to Mike, and he'll be our first speaker.
No, I have to hold this. First of all, I just want to say thanks to everyone who's still sticking around. I know this is not the most exciting of topics, but the fact that you're all here means a lot. Okay. I think the genesis for this discussion today is, we have a lot of clients and we support the industry at a lot of different levels. And there's different things that you're keeping in mind in the very beginning versus sort of as you grow. And we want to be able to be a trusted partner all the way through that, but not just that, but also provide advice. So for those of you that I haven't met before, I've worked for the bank for about 3 years. What most people don't know is I was actually a small business owner for 7.5 years before that. So I am much more accustomed to sitting in your seat than sitting up here. And I've been through that startup process before. I really relate to that. And, in the very beginning, I think a lot of people are trying to keep their head above water. You're sort of scrambling. You're trying to figure out where's up, where's down, and what's what. And after you sort of dial it in, give it a couple of years, you get a little bit of level of comfort. Then the question becomes, okay, how can we sort of begin to grow, begin to expand, and what are the key metrics we're looking for? So one of the big things that I want to take a look at today is financial ingredients for a good company. I mean, all the time, your bank asks you every year, okay, guys, submit your financial statements. We harp on you. Hey, are they here soon enough? No. Have you talked to your accountant, et cetera, et cetera, et cetera. But what is the bank actually looking for when they see your financial statements? I remember being asked that as a small business owner, and I was sort of like, oh, you want okay. And hopefully they're good, But the fact of the matter is there's a lot of really important information, and it's not just from the bank's perspective, it's from your perspective in there. And the idea here is to get a much better look at what are we actually considering when we're looking at financing, and how does this tie into your everyday business? So I'm not going to touch on everything. There's obviously a huge list, but I'm going to touch on 3 key areas. And the idea here really is, can we drive a deeper conversation with your accountant, with your financial partners, and sort of how does this play into the decision-making in the business as a whole? So the first big one, and this is a ratio I'm sure a lot of people have seen, we look at liquidity. And liquidity in a business is realistically, I have short-term assets and I have short-term liabilities. And do I have enough short-term assets, cash, accounts receivable, inventory? Can that be turned into cash on a quick enough basis to pay the bills that I have coming due near term? We're not necessarily talking about, oh, can I pay my rent in 5 years from now? We're looking at over the next 12 months, do we really have the ability to pay all the bills as they become due? And this is a measure of flexibility. When you're looking at your current ratio, and again, this is sort of just one measure, it's an easy conversation with your accountant to talk about, okay, this is what we see on the horizon and how we're going to be able to afford to cover all of that. There's tons of different measures of liquidity. This is the simplest one. It doesn't say everything, but nothing ever does. So this is the one I want to bring up. And most institutions are looking at this as a key metric. So very simple. I know you guys have all seen a balance sheet before. I'm looking at my current assets and my current liabilities, essentially the ratio of the two. And that's where my current ratio sits. Now, people ask me all the time sort of, okay, well, that's great. We have a number. What does that mean? I'm going to give you some very general buckets. And again, it's not just the number, it's the story behind the number, but I'll go into that for a second. So if we're looking at a current ratio, call it less than 1 to 1 is not good, but less than 1.1 to 1, there's concern there. How are we going to cover those bills? How are we going to cover the rent? How are we going to cover wages paid to employees, GST, etc.? If we have less current assets than we have liabilities, there's a liquidity issue, and generally that means a recapitalization of some sort. We have to think about how are we going to make those payments. in here, this is what I would call tight but manageable, right? We've got over that hump and said, okay, yes, we can make the payments. It's manageable. It's not necessarily the greatest, but again, every industry is slightly different. I would like to say that healthy is above the 1.5 mark, somewhere in there. And again, when you're talking to a financial partner or your accountant, they're going to be looking at all this kind of stuff. And they're going to be saying, okay, the health of the business, this is one of the main assessments. Now, I want to mention, as I will with every section here, it's really the story behind the numbers that matters. And that's what's really going to drive that discussion with your accountant. I've had people come up to say, Mike, my current ratio is awesome. We're super liquid. It's 3-1. That's fantastic. But I'll put it in a brewing context. If there's a huge ball of inventory sitting up here, that ratio might look good. But reading into it a little further, maybe you're making a hazy IPA in last year's canning format and nobody wants to drink it. And it's sitting back in the warehouse building up. It's not ever going to turn into cash. The ratio might look good, but there's a whole other story behind it. So those types of conversations, again, once you see the number and you start to ask your accountant, okay, what does this really mean? And how can I have that conversation with the bank? Second big one I want to touch on is leverage. And there are, question? Yeah. So, I mean, every brewery is different. And to be honest, to sort of throw a caveat in there, it also depends on how some things are classified. Often we see statements, and I'm not going to try to go too far in the weeds right now, where someone said, okay, this is a demand loan. I'm putting the whole loan as a current liability. That's going to throw off the ratio. We're making adjustments on the backside of it, so that doesn't necessarily all come through. I would say it's difficult for me to say. I think in general, in the past, worked for about 25, 30 breweries in my portfolio. Often we're seeing somewhere, call it 1.35, right? Sort of more in that manageable area. I'm not expecting everyone to come in at a 3, but again, all these things are only worth what's behind the numbers, right? Leverage, there's literally 1,000 different measures of leverage measuring 1,000 different things. This is a ratio that can tell you all sorts of things. One of the most common versions is balance sheet leverage, and often we'll look at essentially total liabilities. So all of your liabilities, not just the bank debt. What do you owe? What do you owe your employees? What do you owe Canada Revenue? All those types of things over the company's tangible net worth, and I'll get into that in a second. Why does leverage really matter? I mean, there's a lot of reasons, again, depending on the measure, but there's 2 real big reasons that I want to focus on. One is flexibility, and the other one is what we call colloquially skin in the game, right? Think about, the best way I ever had it explained to me was by one of my old university professors, and he showed me leverage like this. He said, okay, imagine this is the cash flows of your business. They're moving up and down, quarterly basis, annual basis, etc. These are your fixed debt payments. I'm going to drop this microphone for a second. For the sake of this, your fixed debt payments are here, and your cash flow is moving around like this. You're in a healthy spot. As your leverage grows, the point in between there begins to shrink. What you don't want to have is a point where you're here and hit a drop where your fixed debt now more than cash. And that's what we call flexibility. The second big one, I think it's fairly self-explanatory, but realistically, skin in the game, a financial partner wants to know that ownership also has something at risk. If we're going to put in more investment, and truly we are a partner, we want to make sure that on the other side, there's something there to lose, so to speak. And I don't want anyone to ever lose anything, but what it does is it keeps incentives aligned, right? If we're going through a tough patch, ownership has a greater incentive to maybe inject some more funds or do what's needed to do, maybe it's sell some shares, etc., to make sure that we ride through. If the ownership is sitting with a very low stake and there's not much at risk, to be quite frank, the bank becomes concerned that it becomes a better option to walk away than to stay in the business. So those are 2 big pieces. Are we still good? Okay. So if I'm measuring balance sheet leverage from this perspective, 2 big things I want to show. So assets, colloquially, this is what you have. Liabilities, this is what you owe. Shareholders' equity, this is what you get. At the end of the day, if your assets were changed in and you paid all your bills, what's left over for your shareholders? And that's the number that we're putting in the denominator here. What is the total amount of what you owe? And what have the shareholders essentially contributed? Where's the difference? And this is our total liabilities to tangible net worth calculation. And again, you'll hear it in different forms. Some people will say total debt to net worth, et cetera. But it's a similar thing. I can get into some specifics later if anybody wants to chat. There's a whole host of things around shareholder loans, et cetera. But the other piece we want to note here is any intangible items, so prepaid expenses, for example, are generally taken out of the denominator. We want to know what the actual tangible asset value is worth. Again, if I'm going to throw it into wide buckets, and these are very wide buckets, at greater than 3.5, we start to get concerned the business might be over-levered. Again, this is industry dependent. Call it 2.5 to 3.75 is that manageable range. And at 2.5, we start to see, okay, this is pretty healthy. So when you're having that discussion with your accountant, measures of leverage are important. And again, this is not the only one. Commonly, you also see measures like funded debt to EBITDA. And I could talk for 20 minutes on ratios. You guys would all be asleep and my colleagues would be yelling at me. So I'm just going to cut it there. Cash flow. This is a big one. I know you guys have all heard this one. Debt service, debt service, debt service, debt service. Senior lending is all about debt service. We are cash flow lenders. Essentially, what we're looking at is the same thing that might be looked at when you go in to get a personal mortgage. First question that's going to get asked, how much money do you make? And then they're going to look at the asset and say, okay, if I need $1 million loan, how much is your annual income? Can you afford to pay monthly payments? And that's exactly what we're talking about here. So we use EBITDA as a proxy for cash flow. It's not perfect, but this is a general sort of industry convention. We use that. And then on the bottom, your scheduled principal and interest payments. So if you have a CSBFL, if you have a loan with the BDC, all those pieces are going in the bottom. And what we're trying to figure out is, okay, at the end of the day, if you have $100,000 left over and your payments are 50 grand, you can make them. If it's swapped, then there's a problem. And that's where we do a lot of our lending. Our main calculation, and most senior banks, looking at cash flow as a number one. Okay, this is the first thing. Can you afford to make the payments that you're proposing? So I'm not going to go too far into a balance sheet or an income statement on that one. I'm just going to show 3 buckets. Again, at 1.1, we're tight. If it's less than 1-to-1, there's a concern. 1.1 to 1.35, somewhere in that neighborhood, we're starting to get comfortable. A lot of institutions will throw out a classic 1.25. Some institutions in the States, that's literally a covenant. It's got to be 1.25. And often I think people will see that covenant with banks here. Sort of 1.35 and above, we're getting into that healthy territory. Now, again, all of this needs to be predicated on what's the story behind the numbers. It's never just the numbers themselves. There's always more. So if I can leave you with anything, it is have a robust discussion with your banker and have a robust discussion with your accountant. We're not just here sort of as the party to ask for like, hey, can you chip in a little bit extra? We want to be able to give advice. We want to be able to see, okay, you're a little bit tight here. We're concerned about X, Y, Z. Maybe there's some different changes that you can make with your accountant, with your staff, in order to try to set the ship straight. Or there might be an issue on the horizon. Or perhaps you have some expensive debt. We've talked about CSBFLs, and Cayenne has talked about it. Often what we see in 2-3 years' time, that expensive debt, that rate that costs you a lot more, may be able to be refinanced. And all of a sudden, you might go from a ratio that looks a little tighter to something that's a little bit smoother. It might be the same amount of money, but at a different rate, all of a sudden, this is affected, and it gives you more room to breathe. So all of these conversations can be had and should be had, and we'll be around for the rest of the day. If anybody ever wants to sit down, talk financials, I'm a geek. I love to do that kind of stuff. If there's a beer involved, that's even better. But seriously, we're here, and I won't belabor the point, but I'm going to let Cayenne chat because I think it's a great sort of segue into looking at term loans for real estate.
So keeping in theme about growing your business, we're going to talk about buying kind of your business premise. So adding to the assets of your business. right? And what that kind of looks like. So buy or rent or buy or lease, right? That's a very common option. A lot of our owners kind of debate over. So at the very core of it, though, like if we're exploring this segue to purchase, sorry, I always start this. The cash flow of the company needs to be solid, like Mike explained, right? If we're looking to purchase a building, you're going to take on a large loan. The bank will need to see a solid cash flow, right? Because at the end of the day, that's it will be the best interest for the business. We won't simply, if the cash flow is not good on the business, then this might not be the best segue to go. So why do owners maybe think about buying? So things like location, right? So if you are in a location that is very important to you, you need to be in that location. If your landlord were to kick you out or to hike your rent, right, that won't work for your business. If that's kind of the case, then you might want to think about purchasing. Another thing you want to think about is leasehold. How much have you invested into improving the condition of the building or adding leasehold improvements to the building? So have you invested quite a lot? Do you want to be investing in the property that you own versus in the property that you're leasing, right? So yeah, most common times we see that the owner wants to go for purchasing versus leasing would be really the amount they're investing in leasehold and the fact that maybe they're tired of rent hikes, right? They want to be able to control that expense because rents are usually the biggest cost of your operating expense. Let's see. Oh, I should go back. So this would work also if you have a large working capital, right? So like I said, if the business has been stabled, you guys have built a large working capital, you're able to inject in a down payment, right? That's where you can start thinking about purchasing premise. So it could be a warehouse for your storage. It could be perhaps the premise that you're operating in, or if you're expanding to a different location, buying that location. Okay. So how does the bank define owner-occupied property, which means a business that you're running, a property that you're running your business out of? So the definition for us is essentially the operating company needs to occupy 50% of the space. So that means you could, if you want, purchase a space and still rent out a smaller portion, right, to another vendor or to another business. As long as that space is less than 50% of the leasable space, we will still consider it as a premise that you're going to operate your business out of. So sometimes an example would be a warehouse with an office space, right? You might only need the warehouse and you're renting out office space to another business, and the office space is smaller than the warehouse space, then yes, it would be a owner-occupied property. What are things that your bank will look at if you come to us to kind of discuss purchasing property? We will look at, number one, cash flow of your operating company. So is there enough income at the end of the day on your business to be able to support this new large debt that you're going to take on? Right? It's a large investment, but it's also a large debt that you're going to take on. It's going to be larger payments. So can your company support that on a monthly basis? Personal guarantee. We talked about that earlier. Cross guarantee. So if it's a newer business, is there another business that can perhaps come in and guarantee this newer business? That's the main one. Types of property. Where is this property located? Is it a warehouse? Is it a retail space? Is it an industrial building? For example, the bank will look at that because that would determine how much we can lend, what loan to value, how long we can lend it over, right? So types of property and location is very important as well. So if it's overall in the Lower Mainland, that's fine. But if you're buying a place in, I don't know, Fort St. John, right, the percentage that we can lend on it, for example, might be a little bit less. Okay, so this is a little chart. It's a lot of information. So your lender will look at, again, the property type, right? So the most common industrial, office, right, or retail. Special use. So different institutions will categorize this differently. For RBC, special use for us, the most common one is if you have a standalone building that's operating a restaurant or an eatery, right? It can only be used by a specific type of business. And if we were to sell it later, substantial improvements or changes would need to be made to that property to be able to lease it to other industries, right? So that we would consider special use and then self-storage. Again, generally for Greater Vancouver, right, population over 35,000, we can lend up to 75%, right, of the purchase or the value, and it goes down as we go into more rural areas. Special use, we can only do 50%, and then self-storage is 65%. Amortization, generally speaking, 25 years is what we can do in Lower Mainland, right? And I know we spoke on the CSBFL earlier, right? So CSBFL is different programs, so that does provide a little bit higher loan to value, but the amortization is a little bit lower. And of course, there's different rates as well for CSBFL. Occupied, owner-occupied only, yeah. Not today, but we can chat after, yeah. And what Mike mentioned before, your debt servicing ratio, so that's what we would use, right, to test, to see if the business can support this additional debt. What kind of things, who here has purchased a commercial building? Oh, awesome. So it's actually quite different from residential real estate process, the lending process, the purchase process, all that stuff. And that's why there's commercial realtors that specialize specifically in commercial real estate. So I would highly recommend to make sure that you do get one that deals with commercial properties. So the biggest difference, the length of time to do an application, right? Personal mortgage, it's easy. We can do that in a week or so. But for commercial mortgages, you do need about 4 to 6 weeks or more from the time that you guys sign the purchase agreement, right, for us to reach funding. And that's because the process is longer. You require 2 lawyers in BC to help complete the legal process. The appraisal is much more comprehensive, and it takes the appraiser sometimes about 2 to 3 weeks, depending how busy they are, to do that full appraisal report. So altogether, because the professionals that you require to fulfill this whole purchase process, it is a longer period. And a commercial realtor would know this, and they will make sure that you guys have appropriate subject removal dates. That will make sure that the financing is in order before closing. What kind of documents we would need for owner-occupied buildings? We would look at, of course, your operating business. So we need your financial statements for your business, right? We would need leases if you guys are renting a portion out. Who's that tenant? We will need that because we will add that, their income or the rent that they're paying to you to help with the servicing. We would need completed statement of affairs, so your net worth picture, purchase agreement, and appraisal reports. And depending on the type of building, we sometimes may need another report we call environmental report. So that's if you were purchasing, it's probably not applicable here, but if you were purchasing a unit that previously was occupied by a gas station or a dry cleaner or something like that, where there might be some chemical contamination previously, then a lot of lenders will require environmental report. So that includes like car detailing shops, etc. What else? That's it. Short, sweet. Perfect. So I'll pass it off to
the ability to pay supplier to take care of the other risks associated with delivery, with completion. You know, a lot of the things that Lyna talked about in terms of getting an import letter of credit or any of the other trade product to help with the acquisition of equipment overseas. We do have a limited ability of paying some suppliers. Certainly we can pay suppliers in Canada and the United States where the business practices are pretty much the same, very similar. We know how common law works for businesses. So we can pay a lot of suppliers in Canada, US, and some places in Europe. So a lot of more companies, though, are buying offshore in China, and we just don't have the same business practices. So we do recommend that you take advantage of trade products that will help you there. So why would you lease equipment? Well, first of all, leasing or financing equipment helps you get the equipment you need today to grow, right? You're not having to save your cash flow. Leases tend to have longer amortizations because the amortizations are closer to the economic life of the equipment. Not the end life of equipment, but the real economic life. So the life until it's starting to really cost money to run that equipment. there's no upfront sales. Sorry, that shouldn't say sales costs. That should say sales taxes. So there's less stress on your day-to-day cash flow. And by refinancing your existing assets, you may be able to free up some equity to use in other parts of your business. And we have the ability to provide up to 100% financing of all types of equipment in the brewing business. We actually can finance any equipment for a business in Canada as long as the equipment is based in Canada. The only exception is we cannot lease passenger vehicles. So no cars, passenger vans. We can lease cargo vans, so delivery trucks, small cargo vans, and we cannot lease pickup trucks. And that's just what we're restricted under one of the governing acts, the Bank Act, from being able to lease that. So how can RBC Equipment Finance help you? Well, we can help you acquire new assets, like brand new assets to you. So in other words, they may be used. So we will look at financing used equipment and we'll refinance your existing equipment. And especially, if you've just bought equipment in the last year and you thought at the time it was a good idea to use cash, and then you say, oh, I could really use that cash for other purposes, we're willing to refinance it at the original cost. So we'll reimburse all of your costs. So it's a great way to put cash back into your business. Now, one of our big advantages is that we will also lease tenant improvement and construction costs. Now, this is the caveat I said at the very beginning. This is the one area that really is restricted to Royal Bank clients. It's mainly because when we're doing equipment financing and we're relying on that asset to create value in your business and cash flow in your business, tenant improvements don't really have value. I can't go back and remove drywall off a wall like I could remove other equipment to pay us in the event of default. So we really only do this for Royal Bank clients. As I mentioned, we will pay suppliers directly, and we will lease equipment, being very clear here, even if you're not having your overall banking relationship with the Royal Bank. So this is the type of equipment. I mean, tanks, canning lines, silos, coolers, freezers, walk-in freezers. Don't limit it to just brewery equipment. There's office equipment, point of sale equipment, security systems, IT, audiovisual. We finance, if you're considering, your tap room, there may be a lot of other assets in there that also could be leased. And we lease delivery trucks and cargo vans. And as I said, we do lease tenant and leasehold improvements. And it basically covers all of the costs. So from permitting and design to the mechanical to plumbing, electrical, like literally drywall, paint, floor covering, window treatment, everything that goes into the construction, we'll be able to finance it. And the beauty is we're able to pay your contractor directly. Just to initiate this, the first step always with credit is to get approval for the credit, but all we want to see is the contractors, your construction contractor. So this leasing is just part of your overall banking relationship. You can obtain credit in the normal course. Now we offer different kinds of lease options. The main option is you have one asset that you need to lease, and you just get a credit facility approved for that asset. But we also have the ability to do multiple purchases on one lease. So we're not just you might take a year to accumulate all the assets that you need to go into your business, and we can put them all on one lease. It's interest-only financing. So a real benefit. You haven't started to pay the lease down. At this point, it's only interest that you're paying. So that really helps with cash flow. And as well, like maybe some of those assets everything's being assembled. So maybe you're not even earning cash on those assets. So it does help to have a little bit of a break on the financing. interest rates. So I'm part of the commercial bank. I didn't want to put a range of what commercial banking rates would look like, but it's the same as term financing. We don't put a premium on a lease because it's a lease. In fact, we really like the leasing business. So we don't treat it as a more expensive way of financing. So clients often say to me, well, how much is it going to cost me? And why would why not just do a term loan? And I said, well, because you're not being charged more to do a lease with us. And there's some benefits to doing the lease as well. We're able to finance on a lease basis a higher level of financing, generally with term financing. You might have to finance the sales taxes, or you may have to pay the sales taxes up front. And we'll only finance, say, 70% of the equipment costs on a term loan. On a lease, we're able to go up to 100%, and you don't have to pay any upfront sales taxes. Now, as I mentioned, we have the ability to do a single lease, but we also have the ability to set you up for an overall limit for credit for a lease. So you could say, well, I know what I'm going to spend this next year. I don't know all the timing on it. I know I'm getting various assets. We can set up a lease line that covers off all your capital expenditures for the year. And then you just come to me and you say, okay, I'm getting this equipment. This is when it's coming. And we set up the lease. You don't have to go back and ask for more credit. So you're just doing this once a year. As I mentioned, we have the ability to put more than one asset on a lease. Maybe this doesn't sound like a big deal, but I have clients that say to me, well, I don't want to have 20 different payments a month from 20 different leases. So this is one way of keeping down the administration. You know exactly when you have to pay, and it's just maybe once a month for your equipment. We also have the ability, as I may have mentioned, is paying deposits or paying progress draws. So a lot of times equipment now, you'll have to put down payment for the equipment, or even to get in a queue for the manufacturing of that equipment. So we're able to pay your suppliers for that. I still put the caveat, though, if it's coming from offshore, like China, we will not pay progress draws in China, but we will pay them in Canada and US and some European countries as well. As I mentioned before, one of the advantages to leasing is we're able to give you longer amortizations. That means you're spreading out the cost over a much longer period of time. So 7 years is pretty common for brewery equipment. And as I mentioned, interest rates are the same as your term loan rates. They're not charged a premium. So why do clients choose leasing? Well, most of it's because we're able to do a higher level of financing. We have longer amortizations that helps your ongoing cash flow. There's no upfront sales taxes, so there's less money that you have to put out upfront to get equipment that you need. We have the ability to have early and flexible repayment schedules. We do progress draws. I didn't mention this, but we're like one of the only banks or the only leasing companies that will do progress draws. This isn't a common thing in the industry. You can unlock your equity in your existing assets. So I haven't gone into a lot of detail about refinancing your own assets, but as I said, if you've acquired assets over time even, and they still have an economic life, we do have the ability to refinance those assets. So we will look at the remaining economic life of that particular piece of equipment. If we feel that it's got reasonable amount of life left in it, we will look to finance that. And usually in a lot of industries and a lot of equipment, we can find out what the value of that equipment is just from Ritchie Brothers, say, or different auction sites. So we don't necessarily need to get a valuation from a professional appraiser to determine what the value of that equipment is. So it's a great way to raise money from your existing assets. And It's also another way of paying out debt from other finance companies that's more expensive than RBC is. So you may want to repay debts from equity holders or debts with other lenders that are more expensive. So same process would apply as in unlocking equity in your assets.
So I'll be quick because it's mostly the same, but I was talking about importing. I'm going to focus a little bit more on the exporting. So who has plans to go outside of Canada in the next short while? Okay, so the same type of risk that I just mentioned this morning just previous session still applies. The biggest part is payment. Now you're selling offshore, you want to be paid, right? And then all the other ones still applies, like country, depending on who you're selling to, country risk, political risk, transfer. How is your buyer going to pay you? Is there going to be foreign exchange control? Can they pay by wire payments, or can they pay by LCs or documentary collection? So we have experience with Egypt last year. All of a sudden, they cannot send wire payments out because they need to control. And everything has to be by way of one of the trade instruments. So you need to be aware of the different trade instruments that's out there, which I just mentioned here. So if you do come across weird instruments, acronyms from your potential buyers, please check with your bank. The bank will be able to let you know whether this is legit or whether this is in your favor. Again, as you can see on this risk continuum, certain instruments are better for buyers, certain instruments are better for sellers. So one thing I want to leave you with today is, okay, this site, not sure whether you can see it. It's rbcglobalconnect.rbc.com. This site, if you can write it down or take a picture, this is all-inclusive one website where it will give you all the information you ever want to know about everything about importing, exporting, international markets. So there's 14 different banks on this platform. RBC is the only bank in Canada on this platform. So it will give you everything that you need to know. I personally like country profiles. So again, if you're importing, exporting from specific countries, you can look at the country information, reports, market reports, for your products in that market. Importers. So there's business directories, databases of potential buyers, potential sellers out there. So you can actually look for this. Trade shows. I'm sure you know what your trade shows around the world, but you can search for trade shows in specific countries that you're interested in there. Tenders, or if there's tenders that you want to tender internationally. This one, personal favorite, sanction list. So you can actually search for entities, individuals, banks, vessels. Yes, vessel can be sanctioned. Companies on this list, and it will show you why they are sanctioned. So it actually scans through 340 different sanction lists internationally. So if you have a counterparty that you're not familiar with, buyers or suppliers, somebody that's just, send you an email, want to deal with you, go here, check it out first. You still have to do your credit due diligence, but this one at least will let you know whether this entity is sanctioned. So you can actually, everybody can enroll. You don't have to be a client of the bank. You can enroll and have access to all this information here. Just play around with that. It's very valuable information. The other service on this website is Trade Club. Trade Club is a trade matchmaking Tinder, trade I call, to match you with other companies that's sponsored by the other 13 banks. So there's minimum criteria that so it has to be a RBC client. There has to be certain credit criteria before we can put you on this platform so that you can be matched with other better companies on this platform. So again, I think this is a valuable tool that you should try, and just, for your either importing or exporting business. Okay.
Yeah, so my name is John Adams. I've been an employee of RBC for 19 years, and I've worked for a division of RBC called RBC Group Advantage for almost 5 years now. And I'll tell you a little bit about what RBC Group Advantage does, but since this presentation is focused a little bit more on well-established breweries or businesses that are trying to get to the next level, focusing on your employees, your human capital is a significant focus for a lot of businesses as they get to that point. So first, we'll just kind of define the focus of my role as I consult and work with various businesses in your industry and other industries as well. So the financial wellness of your employees is important to the success of your company. RBC Group Advantage can help with employee attraction, retention of top talent, and enhance productivity by putting employees on the path of financial wellness. Our program is built on the foundation of advice, support, and strength of RBC Royal Bank, which, of course, earlier this year, RBC celebrated 150 years, just 1 year short of the birth of Canada. So I'm going to use a few key words in this kind of value proposition during my presentation of key themes. Well, the first one is going to be enhancing productivity and understanding how healthy and financially well employees can improve your business production as well. So when you think of the word employees, or you go back to your workplace and you look at the group of people that are there every day with you, they may stir up a few emotions, and for some people that's good, and some it's not so good. Especially in a startup brewery, you probably have a lot of family and friends that are supporting you. They're probably some of your first employees, and you may think family, and literally they may be family. As you grow and you get into the double digits of employees, you probably have to go to the open labor market, and then you have the headaches of HR and managing employees and trying to motivate them and have them show up when they say they're going to be there. And then you have key people that you put a lot of weight on in terms of helping you produce or be effective in business, and then they may be plucked and go to maybe another brewery or go to another industry altogether. So we think about employees as a worthwhile investment to make sure that we do what we can to show that we care about their personal well-being. They show you in return that they care about you and your business as well. So when we're talking about business expenses, and these stats are not, I apologize, they're not brewery specific stats. They're just across Canada, all employers. We have 95% of businesses in Canada indicate that employee wages and benefits are the first or the second largest expense line on their business. So significant investment costs. 40 to 80% of gross revenues typically are going to support employee compensation and benefits. So again, big expense. And 50% of annual compensation is used as a rough estimate when an employee is leaving your organization, the cost in order to replace that employee. And there's many various reasons why there is a cost like that. Sometimes you're recruiting and maybe paying a firm to help you recruit. You may be getting them accredited or doing training for them. You may have downtime or production time where you're not as efficient and able to produce. And then even when you do find that talent, and it takes them to some time to acclimatize to your business, your operations, you also are reducing the productivity of the team around them who are helping train them and get them up to speed. So there's a number of reasons why losing talent, and I'm sure you felt it if you've lost a key person in your business, it really, really is a big burden you're taking on, a high amount of stress, and it affects your operations. So focusing on another area, the financial wellness and leveraging, again, as I mentioned before, showing that care factor, that you care about the financial well-being of their employees, and in turn that can help build that loyalty amongst your employees. And why is it important? Is that for many Canadians, they're under a high or overwhelming, almost 1 out of 2 Canadians are under a lot of stress. And the number one source of stress, the number one source of stress is money-related stress. And, that, especially Metro Vancouver or elsewhere in BC, is probably even higher than other parts of the country as well. We have a very high cost of living due to, of course, our real estate costs primarily, but and car insurance and fuel costs and everything else. 52% of people indicate that they actually have a physical reaction to the stress that they carry, right? So they're irritable, they're losing sleep, it affects their relationships at home potentially. And that can also affect their focus at the workplace and their ability to actually be present, arrive at work and be focused while they're at work. 48% of Canadians indicate that they don't have a financial plan in place, so they're kind of going by the seat of their pants, maybe paycheck to paycheck, and that causes some stress when you don't feel like you have a path to where you're going to achieve your short and long-term goals. And statistics indicate that up to 1 hour a day is lost, or 13% productivity is lost when an employee is under financial stress. So it does have an impact on workplace productivity as well, right? And again, that could be because of their focus. It could be because they're missing time occasionally because they're sick and not well. Now, Canadians do indicate that they want financial education. We know our financial education system, our education system, our public education, doesn't deliver it well. It's one of the most important factors to happiness is some financial stability in life, and yet they really don't dedicate any time in the school system for it. They do want it, 87% that they want education, and the number one source of adult Canadians want to receive their education is actually during work hours. And the second place they want to receive it is maybe during their break time that they have, right? And it's very difficult we all work busy lives. You may have family or recreation or other obligations after work, and if you don't, the last thing you want to do is go in for an hour-long bank appointment. The average Canadian wants to go home and just decompress and relax. So when it is made available to them through their employer, through their workplace, maybe before a shift starts or at the end of the day, it does make a big difference, and they do really appreciate that. And when they are receiving financial advice, they are improving their financial situation. So statistics indicate that they double their financial assets when they're actively working with a financial advisor. And that the longer they work with a financial advisor, the more their investable assets or their household net worth will actually increase over time. So it does make a difference when they're seeking that advice. So the last one I wanted to focus on is employee attraction and retention. And one of the key measures of this list, which is the top 50, or it's actually top 100 top employers in British Columbia list, is the employee benefit package as part of it. And of the top 50, 46 or 92% end up having some sort of benefit plan that they offer to their employee that is a financial benefit, pension plan, profit sharing plan, or retirement savings plan. So it is a significant plan, and there's ways that you can maximize return on investment with these plans. I'll kind of skip over those for the sake of time right now. But plan options, you guys may be familiar with some of these if you've looked at them before, if you've worked for other employers and qualify for benefits. But group RSP, very similar to a normal RSP, except an employer is making it available through payroll. Often they may be contributing or matching a portion as well. It's a very, very popular solution. Group tax-free savings account, the TFSA is about 10 years old now, so it's become more and more regular to see those being available through the workplace. And both of these, neither of them actually does an employer have to contribute a dime to it. They can just make it available as part of the future payroll. And my colleague who spoke previously from ADP, or a colleague partner from ADP, it actually connects really well where you can administer it directly through the ADP payroll system as well. Other solutions would be a defined contribution pension plan. If you were a really large employer, that might be an option. I'd say most medium to smaller employer sizes. One of the top two would be more favorable, a lot less red tape than you'd have with the registered pension plan. And then deferred profit sharing plan, which for many employers that have key people or just people in general, you're wanting to do some good for your employees and give them a financial benefit, but with strings attached. That's what a deferred profit sharing plan, or DPSP, offers. Or you can have a vesting period of up to two years, right? And if they leave, a year and a half in, you take every dime that you put into their DPSP and you're taking it right back. You can use it for your operations. You can distribute to the other employees who are at the company. All right, so very popular option there. And strategy for key employees. So you guys do have many key employees. So as you grow and you're, and no matter what size operation you have, obviously like a brew master and your brew staff are really critical, and yet they're often plucked. Maybe just raise your hands who had taken your current brewmaster from another brewery, or has lost one as far as to another brewery. So there's a few. Yeah, so there's a few of you. And now more and more, because obviously the demand is high, there's many breweries in BC, a lot of people are taking from educational institutions right after they come out of school, which is great. But eventually they may be plucked as well, right? It's just a matter of time. So, the strategies in terms of being able to wrap your arms around them, sometimes you have to look at share ownership. I mean, that's what some are after, or they want creative control. And yet, if they've come into your established operation, creative control may not be something that they can achieve within your operation. So they may have to move to another organization. But programs like this and other benefits you can offer can really help. And you don't have to necessarily offer employee benefits to all staff. In Canada, you do have some liberty in terms of how much you're offering to which employees or employee groups altogether, right? Aside from brew staff, you might have a marketing manager. You may have, if you have food services, you're going to have like your head chef, which is really hard to attract and retain a good, good cook team. So you want to make sure that you're able to wrap your arms around them and make sure that they also understand that you appreciate them and you care about their financial well-being as well. And financial wellness is what we're hoping to achieve. And ultimately, at the end of the day, when someone has a level of financial wellness, which is being able to balance your current financial goals as well as have hope for the future, that's where some of that stress and the financial stress can dissolve away a little bit, and you can actually reduce that stress and focus more on your work and your family and your life. So I thank you. I'm going to give it back to Diane here.
Nathan. Yeah, I've been there when we've brought in Jonathan and his team to our clients to do kind of like financial literacy for employees. And I can tell you, the employees are just mind blown because, a lot of times, even myself, I work at the bank and I don't have time to go in for an hour to see a banker. So the fact that we can come in during lunch and kind of do lunch and learns and stuff. And on top of that, the employee RSP group matching program, I believe in that greatly because that's how I purchased my first home, where with my previous employer giving us that group matching program. So definitely something to think about as you guys grow your company. You're entering your, 5th, 6th year. Your staffing's grown. So definitely something to talk about. Jonathan will be downstairs with us after.